Welcome back. You're watching Stockwatch with me, Julieta Televi, on the graveyard shift this evening, and joining me to take your questions tonight are Ricus Reeders from PSG Wealth and Grant Nader from Benguela Global Fund Managers. If you'd like to send questions, please email stockwatch@bdtv.co.za or via SMS on 41392. Ricus, of course, PSG Hole In Ruimsig is the correct title. Grant, Ricus, good evening to you both. Grant, if I may start with you tonight. It was a pretty strong finish for the JSE today. The gold price, a new high? And some of the gold shares commensurately doing very well today. Just talk us through what is happening on the gold market. What does that signify for you?
Yeah, I mean, that is a very good question. I think, first of all, just on the strength of the market, it is quarter end. It's been a tough quarter for us. And we're down, at one stage we were down over 5% for the year while the rest of the world was up 5%. So the disparity is significant. And so I think there's an element of that driving the market. And of course, there are some drivers, specifically commodities today was the largest. With regard to the gold, I think there's a few factors at play. The one broad underpin has been the geopolitical risk that continues to be prevalent. It's not going anywhere. If anything, with time passing, that risk is actually creeping incrementally higher, whether it's the Russia-Ukraine, NATO moving troops closer to the border, whether it's the Middle East where the peace talks are not happening. Those things are potential sort of tinderboxes that are just bubbling under the surface. And then you've got the prospects of a new rate cutting cycle. And as you get rates cutting, that means you get lower real rates. And the real rate is really like your opportunity cost of holding gold, and as the real rates fall, it's typically supportive of gold. So you've got these number of factors that I think are all playing out in support of gold. And also there's a lot of central bank buying, more than there's been in many years, if you look at the statistics. So there's a fundamental demand underpin at this point in time, plus a number of other reasons you could argue for the strength. Yeah. And having said all of that, gold is gold. Gold could go anywhere tomorrow. That's just the nature of the beast.
I mean, that's part of the trickiness in dealing with a run in the gold price and gold shares on the back of that. Ricus, is that sometimes when you notice it happening, it's too late. And then you think, well, have I missed the boat on this? Your sense, even from a technical point of view, do you think that there's further to run?
Well, yes, I always like things that go to all-time highs, because in essence that confirms an uptrend. It's higher than the previous high. So technically, yes, it can go higher. As Grant has said, there's fundamental reasons that underpin it, although gold is an emotional investment. There is sort of a fundamental underpin, but the wild oscillations are really due to sentiment. But there is that fundamental underpins, all the stuff that Grant was talking about. There's possibly a fear of, inflation not settling within target rates as determined by central banks, but even a little bit higher. And even that's good for gold. So the metal itself can rally further. Technically, it looks very good. But as Grant said, it can turn on a dime and make everybody unhappy again, which is what gold does.
Yeah. Which is why we're so nervous about it, because you think, well, am I just going to burn myself again? Yeah.
Yeah. Unfortunately, it's I think, in my personal experience, and because there's such an emotional legacy with gold, one tends to get in too late unless you were lucky by really picking the bottom. And we know how difficult it is in most cases, and specifically with gold, it is incredibly difficult.
Grant,
I just wanted to add there, sorry, sure. Julieta, if I may, that gold, I think the important thing is to understand why it's in your portfolio if you do buy it. Are you there short-term technically because you think you can make some money, or is it an anti-correlated, uncorrelated, sort of anti-fragile asset, as it can be referred to serve as a counter risk scenario type of thing? So I think it helps to understand, if you have it, why you have it, and don't just buy it because it's going up. You need some kind of understanding of its place in your collection of assets.
We have spoken about this before, but what is the absolute maximum you would allocate to gold if you had it permanently in a way in a portfolio?
Well, I think what the first point to note is that gold is a store of value. It's not an investment in the traditional sense where you're going to expect to generate some kind of return on your investment over time that's potentially quantifiable and you can value it. So gold over time holds its value, but it doesn't grow its value typically. If you go back to, I think you can go back 200 years, gold is essentially kept track with inflation plus about 1%. So it's a very good store of value, but it's not going to grow your wealth. So understand that first of all. Understand that at times it's a really poor asset to hold. At times it's a better asset to hold. For long periods of time, it's a bad asset to hold. So I wouldn't allocate a lot. I would allocate perhaps a little more when I think there's good reason, either tactically or some kind of risk elevation in the system, be it inflation or geopolitics and war, etc. Otherwise, I would cap it at 5% or below. With the ability to maybe add a little more if those other things start to play out or there's a strong conviction on some of that. But it's not something you want to allocate significant portion of money to on an ongoing basis.
Ricus, would you agree with Grant, or do you have a different take?
Yeah, I've got a similar take, and this is going to sound very, I don't know, conspiracy-like, but the amount of gold you should hold is equal to what you would need to get out of a country, for example. Because that's where, no, and I'm not joking. Ask any Ukrainian at the moment.
Yeah.
It's a way to, it is when things go really wrong. It's an asset that you can carry across that is obviously not traceable to anything except that you are carrying it. And that's also the reason that if you buy gold, don't go and buy an ETF. Even if you take a look at what's happening with purchases right now, ETF gold, listed gold exchange rate funds, there's an outflow of that into physical gold because, again, with Russia, you've all of a sudden discovered you might have a paper gold asset somewhere, but anybody can just say, sorry, it's not yours anymore. Yeah. So it really is, first of all, an investment in your own survival. It sounds alarmist, but that is what it is, and that's also what it's done through the ages. And then secondly, as a trading vehicle, you can make a lot of money out of it if you time it right. But the first essential thing is to have gold with you rather than in some paper asset unless you trade it.
Have it with you sewn into the lining of your coat.
Basically, yeah.
Yes, yeah.
And it sounds as if it's never going to happen, but it's happened to countless people over the ages.
Interesting. Just to viewers, please send us questions. You can SMS us 41392 or you can email stockwatch@bdtv.co.za. There was a bit of company news today, but not major companies. Bell Equipment came out with results. I don't know if either of you followed that, or if they're just too small and too erratic in a way. Grant, and on the surface of it, it looked great. Revenue was up massively, 30%. Profit for the year was up 66%. And then they had this huge cash outflow and decided to scrap the dividend. And they said from time to time they have to make big investments in working capital. And the shares crumpled about 9.8% on the back of that. Was that to be expected if you get a big cash call in a company like that?
Yeah, look, first of all, I'll be honest, I didn't see the results. It's not a company I follow. The second point is, yes, there's a lot of risk around the smaller cap companies, around liquidity and funding in this tough environment. So that's the kind of thing that spooks investors. You've seen these liquidity demands causing all sorts of havoc. I mean, TCP is probably an extreme example, but it is a good example. We've had PPC that had to do a rights issue. You've had a number of balance sheet reparations that have happened over the past in a typical of a tough economy. So I'm not surprised that there was that negative reaction.
Ricus, did you have a look at this? What do you think of it? Because actually, having said all this, Bell's actually surprisingly had a pretty good year. Today notwithstanding.
I think about 30% up or something like that. I think the overhanging question surrounding Bell is there going to be another offer to minorities at some stage? So that informs your first decision. Secondly, on the results itself, at a brief glance, as you said, working capital flow not in their favor. So to me, it just sounds like a lot of machines not doing anything. You know, in other words, what they sell, and also withholding the dividend is just to take care of an unproductive asset sitting in your yard waiting to be sold or rented out. But the major thing, I think, is that expectation that there might be corporate action, and at what price, if any, or at least a premium to current price, such an offer would come, and when.
Yeah, okay. There's a question on a viewer who's obviously looking at their tax-free savings options. So that kicked into gear at the first of this month. And the viewer says, I have 36,000 Rand to invest, so that's the limit. What's the panel's view on Signia's S&P 500 ETF or the Satrix MSCI ACW index? I don't know what that is. So
Crunchyroll index.
Okay.
Yeah.
Okay. So Grant, which of those would you pick, or would you split it equally?
So, yeah, I mean, I think they're both very good options. The S&P 500 gives you the 500 biggest companies in the US. The US is currently the best performing developed economy. They have a lot of technology and other sort of earnings momentum. They really are the sort of operational sort of lead in the world at the moment. So that's a good option. The MSCI All Country World Index has about 3,000 companies. So it's a lot more diluted and you've got to get a lot less concentration. The US is about 62-63% of that index. So, understand that you're getting a much lower risk investment. So you should expect slightly lower returns, but with less risk. And you get exposure to China, Japan, Germany, Europe, everywhere. The S&P 500 is just America. So not knowing if the rest of if this investor has a bit more exposure to other regions or to the, if you want to be the most diversified, safest, go the MSCI route. If you already have some exposure to a number of general equity things and are more broadly invested already, you could look at the S&P 500 for perhaps a little more risk, but a potentially higher return, a more concentrated return.
Yeah. Okay.
Would be my view.
Ricus, would you throw it open even further? Or if those were your two choices, where would you go?
I agree with Grant. It's whether you go the S&P 500 route, which means that you are in American listed companies. Obviously, a lot of those are global companies, but it's still the American market. Otherwise, you can go the All Country World Index, have 60% effectively in the S&P 500, and the rest distributed between both developed and developing countries. So it's more of a geographic spread than just one spread. So I would tend to go All Country World Index, and that's maybe because I'm just a little bit more prudent now, and I don't want to be subject to one country specific laws the whole time.
Yeah.
But,
on that point,
yeah.
I mean, would you maybe halve that? So you do 18,000 into the S&P 500 index and then 18,000 into a more specific emerging markets index, say, or I don't know, an ETF that tracks the European, like the Euro stocks.
Okay, so emerging markets outperform at times, but they don't do that consistently because they do not have the technological advantage of developed countries, the global market of developed markets, and in America's case, the business sense of American companies. So you will get periods of outperformance in emerging markets, but that's not really what you want if you're in a tax-free investment. Therefore, I would say stop trying to time cycles and rather go with what is currently your best economy in the world, plus a little bit of risk diversification by not putting all your eggs in one set of country laws by just going to America.
Okay. And the viewer says, do I stick with a portion of 19% of my portfolio on the JSE in Advtech, Bidcorp, Sanlam and Shoprite and just hope for the best? Grant, if those are your... and this viewer is a regular viewer and has quite a big offshore American and European portfolio. Is that what you would stick with, or would you maybe increase that or decrease that at this point?
So if I heard you right, it's four companies make up 19%, so just
Yeah.
under 5% per company.
Yeah.
And I will say they're all pretty high quality businesses,
Yep.
some of the best operators in South Africa. So absolutely nothing wrong with that. The viewer obviously, wants to own good companies. I don't think it's a bad spread. I think you could, if you love the quality, I wouldn't. I think you can stay in SA to that extent. You've got 80/20. That's a very nice diversified risk. You're not taking too much risk in SA, so I like that. And I think there's nothing wrong with those four stocks. You could, if you find one or two others that you like, you could dilute down to maybe 3 or 4%. But just to manage perhaps a little bit of risk, but you've already done that to some extent by the quality you own. So perhaps you could diversify in sector. So perhaps own a Richmond or one of the other something in a different sector to those four. Is perhaps you could take it to 6 stocks and cover a few more sectors. But I think it's a fairly robust little portfolio.
Yeah. And the irony, I suppose, that Bidcorp and Sanlam are not necessarily, wholly reliant on South Africa. And if you added Richemont to the mix, that's not reliant on South Africa at all. Yeah. Ricus, would you do as Grant suggests? I mean, if you had to do anything, maybe add 1 or 2 more South African stocks to that mix, but keep the portfolio split at 80% offshore, 20% local?
Yeah, this is an interesting one. As Grant has said, talking my book here, but I mean, those are major parts of my own portfolio, of my own model. So if you want to be in 20% in South Africa in only 4 stocks, nothing wrong with those. Secondly, you've got the ability to change your mind should it turn out that 1 or 2 of those stocks aren't good to be in South Africa, in which case I would, from my own standpoint, say, okay, 20% in just one emerging market economy doesn't sound prudent. So I would tend to say, well, okay, if 1 or 2 of them start disappointing, either diversify into something similar offshore, or as you said, possibly if you for some legal reason have to keep it in South Africa, then diversify through some kind of rand hedge. But yeah, I think the end point is watch out for overconcentration, again, geography in one specific company or in one specific country, although those 4 stocks are great as far as the South African environment is concerned. But monitor it. If it disappoints, you can sell it, you can move it offshore, you can go buy a similar company offshore.
Yeah. Okay. Just as we wait for other questions to come in, I don't know if either of you look at Jubilee or if it's far too small. It's, of course, a junior. Well, it's got slightly diversified interest. They've got chrome, PGM, and copper. And the announcement today was on a copper project that they've got in Zambia, which they're developing in conjunction with an offshore. Sorry, I don't know if it's a Dubai-based or Saudi Arabian company, but they are quite positive with it. They're going ahead with it, and the shares were up quite nicely, 3.76%. Grant, is this one that you look at? I mean, if you had to throw in some fairly high-risk mining stocks into a little bag, would Jubilee be one of them?
Yeah, this certainly is in the risky bucket. This is in the fun bucket. Yeah, I think I don't know the company too well, but I do know that copper is a good metal to have exposure to. Chrome is, I think the prospects are fairly decent. PGMs, well, the jury's out on that, but given where we are in the cycle, I think the risk reward is probably in your favor as well. So it's a fairly decent little operator. That's the full extent of it. So a small allocation would be absolutely fine. Just understand what it, that it's not your overweight, and it's not the one you put in the bottom drawer and expect it to be there in 5 years' time. Just understand what you're buying.
Yes, it may not exist in 5 years' time, although actually it's been around for a while.
Could have tripled. Yeah,
could have tripled, exactly. Sorry, it was an Abu Dhabi a company called International Resources Holding. Ricus, is this one that you ever cast a gaze over?
I do. And as you said, I mean, they've been around for a while now, and surprisingly, because it doesn't normally happen with, shall we say, developing mining companies. They have delivered constantly. I don't think I've ever come, where something went wrong. Where there's a refrigeration unit that didn't work or anything like that. The management of the projects that they have developed, both locally and obviously also in Zambia, have consistently delivered on time um, and and within budget. They are a mining company, therefore they will be volatile. But I like their track record. So it is. I don't think it's got institutional holdings because they are so small. But I won't discard it as a cowboy type of company. They seem to be extraordinarily well managed. You know, it's sort of similar to Afrimat. You know, start small, manage well, and people will start noticing it. As to the fact that they are in a place like Zambia, I don't think Zambia is a heck of a lot riskier than having all your gold operations in South Africa, like Harmony, for example.
Exactly.
Not in the current scenario that this country is in. So just because it's not South Africa, but in Africa, don't, you know, it's not necessarily more risky. So I think it's one to keep an eye on.
Okay. In fact, when I spoke to the CEO of Impala Platinum, Nico Muller, he said that they might actually consider developing their Zimbabwean assets more readily than they would their South African assets, because they seem to be very secure in how they see the tenure there, which is fascinating. A sort of a technical question here. Please ask your guests some administration questions. I'm a South African, I've been using Standard Bank online share trading for many years. 2 years ago, I moved to Switzerland. I still have my South African passport. I'm still a South African citizen, still banking in SA, but now Standard Bank want to close my trading account. Why can I not have an account with them while residing in Switzerland, which has a double tax treaty with South Africa? Would either of you know a quick answer to this offhand, or is this maybe an issue between the viewer and their bank?
Sounds unusual to me.
Yeah.
I can't think of any obvious reason that that's not okay.
Yeah, I mean, I was dealing a little bit earlier this afternoon with a client of mine that resides in Germany, you know, exactly the same situation as the viewer. And what I had to do was just get a document signed to get him fully tax compliant, and that's it. So unless there's a compliance issue, I cannot see an obvious reason for not being able to have a local equity account while residing offshore.
Yeah. Okay, so something for the viewer to take up with their trading platform. I shall get your stock picks now. Grant, what are you going for this evening?
So I'm going for Amazon. And the reason is, you know, I think you're getting two good stories there. I think you've got the cloud services. They've been resetting and rebuilding, and you've got this opportunity to capitalize on AI as it unfolds. They're one of the better infrastructure hyperscalers. They're positioned well to capture the margin and the expansion of that industry. And we're in a big rollout phase of that entire global infrastructure rollout, and they are very well placed to be front and center for that. That's the first thing on that side of things. And then on the retail side, they are focused, really cost conscious. They've got this strong margin expansion profile. The advertising revenue is becoming an absolute juggernaut in terms of business. And so I think you're going to see this two-pronged improvement in margins on both sides of the business. And I think there's a lot of runway there. So I like it. I think you've got a strong runway for growth, and that would be my pick.
Yeah. And what a pick it has been over the last year. Ricus, how about you?
Also sort of in retail, but a lot more, or not as adventurous as an Amazon, and that's Procter & Gamble in the US. They're a consumer goods company, and if you want to know what kind of product they sell, walk into Clicks is that kind of product, whether it be beauty or health, you know, toothpaste, that kind of thing. So it's pretty defensive from a consumer side, and I also think it's pretty defensive from a stock perspective, because, you know, if one takes a look at some of the valuations that we have offshore, specifically in America. Added to that is the fact that they've had a consistent dividend growth of almost 70 years now. They don't really, you know, they grow their dividend every year. Makes it very defensive and very well managed as far as I'm concerned, and the graph looks good.
Yeah, there we go. And you know, US GDP growth revised upwards to 3.4% for the fourth quarter. So it really is the whole economy is a juggernaut. Ricus and Grant, thank you very much for joining me, as I said, on the graveyard shifts. I really appreciate your time this evening. Ricus Reeders is from PSG Hole In Ruimsig. Grant Nader is from Benguela Global Fund Managers. Thanks for joining us. Hope you have a lovely Easter. Up next, the close. Stay with us.